Liquidation in finance and economics is the process of bringing a business to an end and distributing its assets to claimants. It is an event that usually occurs when a company is insolvent, meaning it cannot pay its obligations when they are due. As company operations end, the remaining assets are used to pay creditors and shareholders based on the priority of their claims. General partners are subject to liquidation. The term liquidation may also be used to refer to the selling of poor-performing goods at a price lower than the cost to the business or at a price lower than the business desires. Before we get into more details about liquidation and some examples of bankruptcies, don't forget that we have a bonus fact for you towards the end of the video. Number 1. Process. The directors decide to voluntarily liquidate a business due to inadequate cash flow. Dissolution becomes the only option for paying off the creditors. Alternatively, the court can order the compulsory dissolution of a business. The company or the court appoints an insolvency professional or IP as the official liquidator to take charge of the process. At this stage, the owners lose their powers and rights. The liquidator takes over. The insolvency professional dissolves the assets after assessing. Next, the liquidator determines all the payables and debts of the company. Finally, the authorized liquidator distributes the funds among claiming parties based on the standard priority order. The company ceases to exist and is taken off the Register of Companies or ROC. Number 2. Priority of claims. Secured. First, the company settles its preferential creditors such as employees and landlord, reimburses all secured creditors like the bank that provided the mortgage loan, and pays the insolvency practitioner hired for liquidation. Unsecured. Then come the suppliers, HMRC, contractors, debenture holders, credit card companies, and other lenders or creditors not backed by collateral. Stakeholders. Finally, the residual funds are distributed among shareholders, investors, and owners. Number 3. Types of liquidation. Forced or compulsory liquidation. When that is the case, the creditors appeal to the court to dissolve the firm. The creditors no longer believe the firm can pay them back. Members' voluntary liquidation. When a company is solvent and can pay off all its liabilities, dissolutions occur by consent. Sometimes the purpose behind the forming of a company is fulfilled and the owners want to wind up. Alternatively, business owners could be transferred or the firm may undergo a restructuring. Creditors' voluntary liquidation. In this case, the company becomes insolvent and the directors or owners initiate this process to avoid court intervention or compulsory dissolution. In short, the business declares insolvency before the creditors take any legitimate action against it. Number 4. Liquidation examples. Marca, the popular retail and leisure brand of UAE, was declared bankrupt by the Dubai court. The court ordered liquidation. Along with the parent firm, legal notices were sent to the company's subsidiaries as well. The court-appointed bankruptcy trustee asked the directors to hand over all the documents, assets, and funds. Also, the court ordered the board of directors to pay 448 million dirhams to the creditors. The penalty was levied because the directors were responsible for the company's mismanagement and non-disclosure of accurate financial information. Design Studio Group. The Singapore-based global interior design company decided to wind up voluntarily. The DSG Board of Directors filed a winding-up application on October 27, 2021. This action was taken due to the business's inability to generate sufficient cash flow to pay off corporate debts. Pier 1. A few years of cratering sales and failed turnaround effects sent Pier 1 into bankruptcy court. Early in the going, it had hopes of finding a buyer in Chapter 11 or possibly reorganizing. Nobody emerged despite reports that it had a potential suitor. With the company's cash burn and a market position shattered by rising forces in the home category like Wayfair and TJX.Co's Home Goods, it would have been a tough sell to a buyer. Without a sale, Pier 1 moved to liquidate its physical business. Number 5. Post-pandemic bankruptcies. Diamond Offshore Drilling. The contract drilling company filed for Chapter 11 bankruptcy on April 26 of 2020. The Houston-based company named low oil demand amid the coronavirus outbreak and the price war between OPEC and Russia as factors that caused its business to decline. Prior to filing for bankruptcy, Diamond Offshore skipped an interest payment and secured restructuring advisors. The company also recently drew down $400 million under a revolving credit facility. Diamond Offshore currently has enough capital to continue normal operations as it undergoes restructuring efforts, according to a company statement. Diamond Offshore reported $981 million in revenue in 2019. The company had employed 2,500 workers at the end of last year. Frontier Communications, the high-speed internet company, announced that it was initiating bankruptcy proceedings. Frontier Communications also said it was proceeding with the sale of its Washington, Oregon, Idaho, and Montana operations and assets to Northwest Fiber for around $1.35 billion in cash. The company expects its restructuring plan to reduce its debt by more than $10 billion. It also said it has received $460 million in debtor-in-possession financing. Combined with the company's more than $700 million in cash, the DIP financing will allow Frontier to have more than $1.5 billion in liquidity that will help it meet operational needs. Frontier has fiber optic and copper networks in 29 states. The company said it had $8.1 billion in annual revenue in 2019, according to an SEC filing. J. Crew, the New York apparel company, filed for bankruptcy on May 4 after struggling with slumping sales and huge debt. Its debt was largely the legacy of a leveraged buyout by private equity firms TPG Capital and Leonard Green and Partners, which bought it for $3 billion in 2011. The retailer had roughly $2.5 billion in annual sales, according to Moody's. But with all its locations forced to close temporarily to halt the spread of COVID-19, sales slowed to a trickle. As part of the bankruptcy proceedings, J. Crew's lenders will convert around $1.65 billion of its debt into equity. The retailers also secured $400 million in financing from current lenders in order to stay in operation during its restructuring. Number 6. Retail bankruptcies in 2020. Neiman Marcus, with assets of more than $5 billion and liabilities of more than $5 billion, the upscale department store chain filed for Chapter 11 in early May of 2020, marking one of the highest-profile retail collapses during the pandemic. After eliminating billions in debt, Neiman brought on a new board of directors that included former LVMH North America chair Pauline Brown and former eBay chief strategy officer Chris Miller. Jeffrey Van Remdonk has remained as CEO. As part of its restructuring, Neiman has closed a handful of shops, including a massive store at Hudson Yards in New York that had hardly been open for a year. Over the next 3 years, the company has earmarked more than $160 million to invest in its stores, including renovating its Dallas flagship, the CEO said in a recent interview. Guitar Center. Guitar Center started its business in Hollywood in the 1950s selling home organs and grew to become a leader in the music category. But temporary store closures brought on by the pandemic hurt the company as shoppers turned to the internet to buy instruments and sheet music. With assets of more than $1 billion and liabilities of the same amount, the retailer, which employed roughly 13,000 people, filed for Chapter 11 in late November 2020. The retailer and stakeholders reached a restructuring agreement that slashes its debts by almost $800 million and raises as much as $165 million in new equity. And now it's time for the promised bonus fact, but before that, we would like to thank you for staying with us this far. About 60% of the retailers that had filed for bankruptcy in 2020 through August listed more than $100 million in assets, compared with 50% of filings during the same period in 2019 and 36% in 2018. What do you think about the companies that went bankrupt? Comment down below and let us know if you had a favorite among these. If you enjoyed the content, uplift the channel by hitting like, subscribe, and ring the YouTube bell to meet us again in the next video. Until next time.